As we move squarely into finance, let's just give an overview of what finance is all about. Finance, as opposed to accounting, is concerned with decisions about money, which means that we're going to be more interested in cash flows than things like income. Because financial decisions deal with how firms raise money and how they use it. So if everything else is equal, we're going to prefer more value to less. We're going to prefer to receive cash sooner than later, and we're going to prefer less risky assets to more risky assets. So thinking about the broad general areas of finance, we typically think of them as financial markets and institutions, that's sometimes called banking, investments, financial services, which is very close to markets and institutions. This is basically not just the entities, but the services that those entities perform. And then managerial finance, which is sometimes called corporate finance. So now if the question is, well then what kind of job can I get in finance? This is where finance fits into a firm, typically speaking. Typically speaking, the highest finance job is the chief financial officer. That chief financial officer has reporting to them the treasurer and the controller. The treasurer takes care of things like credit and inventory and capital budgets, and then the controller takes care of the accounting function, so financial and cost, and then taxes. Now you've probably seen this a million times. The primary, I shouldn't exaggerate, you've probably seen this before, but the primary forms of business organization: proprietorship, partnership, and corporation. Sometimes we think of these as kind of a life cycle for a firm, that they may start out as a sole proprietorship where there's just one owner and that owner has complete liability. Then it may evolve to a partnership where there's two or more owners that share the liability for the firm, and then become finally a corporation, either an S corporation or a C corporation, where those owners have limited liability. We're primarily going to focus on corporations, but let's just talk briefly, very briefly, because this should be review, about those three forms. So we talked about the proprietorship, very easy to get started, few regulations, and it by itself is not subject to income taxes. But we've got the liability issue, we've got the life of this entity is limited to the life of that owner, which makes it very difficult to transfer ownership and raise capital. A partnership is very similar to the proprietorship, but as I mentioned before, it has two or more owners. And after that, the advantages and disadvantages are basically the same. But when we get to the corporation, because the corporation is a separate entity from its owners, it has an unlimited life. You can transfer ownership very easily through stock. Those owners have limited liability, and because of the stock transaction, it's very easy to raise capital. Disadvantages: you've got a whole lot more paperwork and double taxation because the corporation is taxed and then the owners are taxed on any dividends that they receive. There are also some hybrid forms of business that are very popular these days, like a limited liability partnership, a limited liability company. These are very popular for certain types of entities like law firms, medical practices, accounting firms, and then an S corporation is going to be very popular for smaller firms. So organizing as a corporation is what we're going to focus on. It maximizes value because of the limited liability and the ease of raising capital, as well as the ability to transfer ownership through stock transactions. But the most important concept in the finance part of this course is the primary goal of the financial professional in a corporation, and that is to maximize stockholder wealth. So that means that they're going to maximize stock price, which in turn maximizes stockholder wealth. And so sometimes that's a little bit tricky for a firm because they may want to focus on other things like revenues or income or buying new planes or something like that, but the management of the firm reports to the board of directors, who are kind of acting on behalf of the shareholders. So ultimately, it's the shareholders that we need to please. And so sometimes we'll use managerial incentives, and then in some regards, some sense of social responsibility to try to keep managers on track and doing the right thing. And so the way that they do the right thing is that they make capital structure decisions or capital budgeting decisions or dividend policy decisions, keeping those shareholders in mind. Thinking about, as I make this decision and I do the financial analysis, which decision is going to maximize stock price in the long run. So I'm not going to go through this graphic in detail, but because we're going to work through this over the next few weeks, it's telling you where firm value is coming from. And that's important for the manager to keep in mind, because that's his job, is to maximize this value. So he's got to think about the factors that impact the value of the firm, that the firm can control and that the firm can't control, and how those relate to cash flows and returns. So the factors that they can control are cash flows, the timing of those cash flows, the riskiness of the projects that they take on, and how they use debt in their capital structure or dividends in their dividend policy. And again, I'm kind of going through these quickly because we're going to talk about all this. This is an overview to kind of tell you what things are on the horizon. So now, another conceptual issue that you should be aware of is the existence of agency relationships. These agency relationships arise because you have an agent, who in this case is the manager, acting on behalf of the principal. So this we touched on this really earlier when we talked about managerial incentives in order to keep the manager acting on the shareholder's behalf. Again, maximizing shareholder value, or making decisions that will maximize stock price and therefore shareholder value. And so that's how we deal with this potential agency problem. Another problem that you should be aware of is the conflict between shareholders or stockholders and managers. Well, and actually, this is the same problem that we've been talking about throughout, which is this agency problem. And so some other ways to incentivize those managers to do what the shareholders want, incentive packages, intervening and just getting rid of them, or the threat of takeover, because in a takeover, frequently managers lose their job. Just keep in mind that as managers are making all these decisions on behalf of the shareholder, they also have to be ethical. And so they're keeping in mind the interests of the greater community as well. Last few things to think about, corporate governance. This became very important after Sarbanes-Oxley in 2002, which came on the heels of a lot of bad stuff that managers were doing. So taking on perquisites, mismanaging corporate assets, and so on. And so there is a lot more oversight when it comes to the actions that managers take on behalf of the firm. Remember also that most of the firms we work with are multinational firms, meaning they're doing business either buying or selling or both in other countries. And so we have to think about why that may or may not be a good idea for certain firms. And what makes a multinational firm different from a domestic firm. They've got more problems because they've got more currency, more political issues, more cultural issues to deal with.